Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have Chuck Mack, Head of Strategic Operations and Public Policy at Nasdaq, as well as Frank Salla, CEO of DTCC. We're here to discuss how market structure and technology are evolving, built on resilience, transparency, and investor trust. It is great to have the both of you with us. Welcome to Trade Talks, and certainly an exciting time to be talking about the evolution of market structure. Chuck, before we get into the conversation, give us a brief overview of NASDAQ and its role in the market structure ecosystem.
Sure, and thanks for having me, Jill. So the NASDAQ stock market is obviously a global equities exchange. We operate options markets in the United States. We operate exchanges in Canada, and really we operate exchanges throughout the globe and provide technology throughout the entire financial ecosystem. And so when it comes to U.S. market structure, we're a key player and contributor to the development and evolution of the markets.
And Frank, DTCC's role?
Yeah, so the Depository Trust and Clearing Corporation is essentially the central securities depository for all of the U.S. capital markets. So we have about $100 trillion of U.S. securities that we settle and clear for the industry. And the way to think about our company is at our essence, we maintain the integrity of the ledger for the entire industry, for stocks and bonds, et cetera, et cetera.
What's your thoughts on where we are right now with market structure? It seems to be that the evolution is happening quickly with the introduction of all this technology.
It is. It's probably one of the most exciting times I could remember for market infrastructure, and most people don't think of it as exciting, but with the new technology, whether it's blockchain or AI, the innovation that's taking over the industry with the growth of the capital markets, both public and private, and these new technologies that come in have just made market infrastructure a really fun place to be, and being able to provide efficiencies, reducing risk, and helping investors invest in a more efficient way has never been evolving as quickly as I could remember in 30 plus years in the industry.
Yeah, it really is an inflection point of how markets operate where we are right now.
Yeah, and I would say to Frank's point on infrastructure being exciting, most of the time I think people don't even think of the stuff that's behind the scenes, and it just works, and that's really great for everybody that they don't even have to think about it. But all of a sudden, it's just an exciting topic because there's all these new ideas around, how we could change or improve all this infrastructure and plumbing.
Right, and that's the point, right? It comes back to user experience at the end of the day and investor protection. Right. So that's exactly what investors want to see market infrastructure achieve. And one of those, Frank, was T+1. I mean, that was a milestone in risk reduction.
It was, to think about it, to execute on a trade and then pay for it and settle it 2 days later was fine. And the industry had evolved from T+5 many, many years ago to go to T+1. And the implications of that may not be evident to the investing public, but the truth is you do a trade and then the next day you settle it. That reduced a tremendous amount of risk out of the system, but more importantly, it allowed to put liquidity back to the industry, which the industry needs. Economies grow, wealth grows, financial institutions need more capital to continue to reinvest. And one way we were able to help the industry was through T+1. We were able to give back at DTCC for our members. On any given day in a T+2 environment, we had about $12, $13 billion in our clearing fund. It's only $9 billion, so we were able to return $3 billion a day back to the industry for it to use for other things, which helps the economy and helps the financial services industry. It was a tremendous effort in many ways, initiated, regulatorily by the chairman of the SEC at the time, Gary Gensler, and the industry got together and drove it in a very meaningful and successul way.
Yeah, Chuck, I'm sorry.
Yeah, I was going to say to Frank's point about that capital efficiency and that money going back into the system, if you think about, for example, market makers providing quotes on the screen to investors, every little cost goes into that price that they're putting out in that market. So that $3 billion that Frank talked about is really significant as far as returning that value back to end investors.
Yeah.
And the other thing I would say too, and Frank touched on this, is the industry worked together on this. It was an amazing effort. I mean, it came off seamlessly. A lot of effort went into it, and it was because of the previous move to T2. I think we had this great playbook that the DTCC had put together that everyone could run by to go to T+1.
Yeah, we were able to leverage it, and Chuck's point is really important. The fact the more efficiencies we can do, whether it's through the exchanges like Nasdaq or what we try to do with DTCC, that should translate to better price discovery for investors, which is really an important point. And at the end of the day, it does help end investors as well. It's all interconnected, you know.
Right. So that move from T2 to T1 was significant.
Absolutely. It was another major milestone for the industry. As we said, risk reduction, potentially price discovery, efficiency, reduction of risk is always top of mind.
Yeah, especially in periods of high volume and volatility.
Yeah, absolutely. I mean, that's really, whenever risk comes into play, it's multiplied when you've got a high stress environment going on. If there's volatility in the market or big economic events occurring, having that reduced risk period is really meaningful.
And you know, the other point that I think is important to make, and people may not appreciate it, but Chuck alluded to the amount of testing and work within the industry, all the industry participants, to make sure we were ready for T+1. A number of large organizations and small organizations had to modernize their tech stack.
Right.
And the thing that no one could have anticipated was the amount of volatility and volumes since T1 was established, and the industry works really efficiently, even in a shortened settlement cycle. And you know, people don't talk about it because, we said earlier, it's taken for granted,
right.
But it just improved capital markets and the way they operate and the efficiencies that they deliver to investors.
Yeah. Chuck, you were talking about testing and all the work that goes into it. I'm trying to wrap my head around Nasdaq and what our processes were. I mean, how long did it take? What kind of team does it take to do it? What was the you know, lift the curtain back for us?
Sure, so it is a tremendous amount of testing and effort and planning, really, a ton of planning, and you're coordinating with the industry, so you have, you know, your industry-facing folks, you're coordinating with technology, so you have your technology team, you're coordinating with your legal team, because there's rule changes, you're coordinating with your operations team, and then you're bringing them all together at the same time to kind of move in the same direction together. So it's a tremendous amount of planning, and not just within Nasdaq, but across the industry as well, and to coordinate all that is certainly a pretty big Jenga puzzle.
What about the global implications of T+1?
Well, I do think, you know, the U.S. is a unique market. It's you know, exceptional in many ways. It's the deepest and most liquid market, and so I think the rest of the globe does pay attention to what we're doing, and then you've got implications of like, okay, if the U.S. is T+1, but we're T+2 over here, are we okay with that, or do we want to start to move and be T+1? I think what we're seeing is what you'd expect is everybody's going to start to move to T+1 if they're not already.
No, I think Europe and the UK and the EU caught exactly what you said very early on and said maybe this puts us at a competitive disadvantage. We need to move, and they've already set dates, which are coming at the end of 27, I think it's October 2027. We get visitors from Asia as well, from, you know, Southeast Asia, to come in and say, what was your experience in this? What were the benefits that you got? So it clearly was a trigger to move other parts of the world to go to T+1 as well. So, and there is now a concerted effort everywhere to really consider it, and as we said, you know, Europe is moving in that direction very quickly. So it was in many ways it was another watershed event.
Yeah, and moving along to the next big thing, 24/5 trading. I mean, Chuck, is the demand real for that?
Yeah, it sure is, and I would say, you know, things like moving to T+1 and wherever that's going to open the door to help us set up for things like 24/5 trading. You know, kind of going back to the point I made a second ago about everybody kind of looking to the U.S. and the U.S. Capital markets being unique and deep and liquid, there's a lot of demand for Nasdaq-listed securities, for example, across the globe, and we're seeing specific demand from the Asia-Pacific region. And currently we operate 16 hours a day, but the 8 hours we don't operate happens to be the daytime for that region. And so with that demand, we need to pay attention to that. We need to move in that direction. But at the same time, you know, we've been talking about infrastructure quite a bit. We got to make sure all the infrastructure moves with us. So again, it's another time where we're coordinating not amongst all the teams I named within Nasdaq, but also across the industry and working together to make sure we do it right and safely and keep those investor protections and keep that liquidity.
Yeah, I mean, you play a pivotal role in that as well.
Yes, well, again, the investor demand is to move to 24/5, and we're working as an industry to get that going, and we will, and I think by the second quarter of 26 that will begin. But you can't move to 24/5 and compromise risk. You can't move to 24/5 and compromise price discovery. So it's a very knotty issue. It's not just a technology thing where you turn a switch and it happens. So we are engaging very actively with the industry on things like, okay, in a 24/5 environment, what's an X date? What's a dividend date? What's a corporate action date? What is end of day? When does it begin? But again, it's to meet the needs, as Chuck rightly said, of an investor class globally that wants more access to the U.S. markets, and how do you make sure they have the liquidity and the price discovery to do what they want to do? But again, I think it'll be another watershed event, and it will probably move other markets around the world to continuously have price discovery in certain asset classes when they want it, when it's convenient for them.
Right. So when you think about that, when you move to 24/5 trading, Chuck, is 9:30 to 4 still the market, or where you would expect liquidity events to take place, whether it's corporate actions or bringing new issues to market?
Yeah, it's a good question. It's one that comes up a lot, and I think there's a couple ways to think about it. One is, even now, like I said, we operate 16 hours a day, but the bulk of the liquidity and the activity is still that 9:30 to 4 time period. And you've also got two pivotal moments of the day. Then you've got the 9:30 market open, and you've got the 4 o'clock close, and those are both auction events. And there are a tremendous amount of assets that are benchmarked to those events. And because of the deep liquidity in those events, it actually attracts a lot of activity for participants who are really looking for a significant liquidity event. So I don't think that part will change too much. I think the other thing to note is the hours outside of 9:34, the demand that we see there is much more individual investor focused and a lot less institutional. That could change over time, but I think in the at least near to medium term, we're going to continue to see that be more of a retail focus and less of an institutional focus.
Yeah, and that's a great point to move along to how you think the market structure is going to continue to evolve. I mean, the technology, forget about Moore's Law, it's happening even quicker.
It is, yeah, there's no doubt about it.
Yeah.
No, look, technology is clearly, as we said earlier, transforming the industry, and nowhere else but like in blockchain, right? And as it's interesting, a few years ago, the conversation in the industry was, how is blockchain going to basically totally revolutionize the financial services ecosystem? And I think it took us as an industry a little time to sort of get on the same page in terms of the vernacular. Are we using the right terminology? Are we using it consistently? How do you deal with a pretty good, well-functioning financial services ecosystem with a very mature regulatory wrapper around it and a very, very advanced and mature risk wrap around it? And I think where the industry is now is very healthy, and it's that we're all talking the same language. There's a better understanding of the technology and where it can be leveraged in a well-functioning ecosystem. And I think it's more about how do we deploy this very powerful technology into an ecosystem that already exists, but make that ecosystem better, not turn that ecosystem on its head and just change it altogether. And that's a really good, sober, mature conversation to have. And many of us in the industry are now working together to solve for that. And how do you tokenize securities? What does that mean for the end investor? How do you deliver more efficiency, maybe reduce cost? And those are the very active conversations we're having now in the industry. And there are other very exciting opportunities it delivers. Think about collateral mobility. In a future state, you can see where we could deliver US dollar liquidity to Asia. So on Sunday night in the US, we're delivering dollar liquidity in Asia, which is Monday morning, fully collateralized. That really doesn't happen today. So the technology is going to allow us to do things and explore things that we can't do right now, which will, again, will be good for the evolution of the markets and good for investors and good for financial services in general.
Yeah, and from Nasdaq's perspective, resiliency and investor trust, that ethos isn't going to change regardless.
Yeah,
of
no doubt. And I mean, I was going to make that point. It's the markets continue to evolve forever. When it gets really interesting, though, is when you have sort of a convergence of multiple technologies and consumer trends and investor trends kind of coming together, which is, I think, what we're starting to see now, where you've got blockchain, we've got cloud, you've got artificial intelligence, you've got slightly different demands from individual retail investors. And so we want to meet that demand. Thinking about tokenization of securities and mobility of securities and that type of thing. But we want to do it, as Frank said, in a safe wrapper. We've got a very good and strong regulatory structure in the US markets, and that's a key piece of why the markets have been so successful. So for us, it's like, okay, how do we take this big convergence, evolve the markets in great ways, but let's make sure we keep investors safe and keep the integrity of the market intact.
Yeah, and I know you also strongly advocate for collaboration within the industry as well.
Yeah, absolutely. I think that's key, especially in a mature industry like this one. The collaboration is key.
Yeah. And you spoke about resiliency earlier, and I think that's a real area where there is real industry collaboration. We talked about T1, right? We're talking about new technology. The thing that I'm seeing in the industry now is many financial services organizations, whether they're exchanges or CSDs or other banks, brokers, they focused on resiliency in their silo. The conversation that's going now on in the industry is, how do we work horizontally to protect each other in the event something goes wrong? And I think that's very encouraging. So you've got, people take off their competitive hats and they say, okay, how do we coordinate as an industry to make sure that the industry is resilient, not just our own firm?
Yeah.
And that's great for investor confidence, because as Chuck was alluding to, the last thing any of us want to do is rattle investor confidence. Yeah. That's the death knell for us. So the evolution and the direction of travel is pretty encouraging.
I thought COVID as a use case is a prime example of that, considering the amount of volume and liquidity sourcing and volatility that we saw in such a short period of time, and how resilient the markets were. I think that's a perfect use case for it.
Yeah, it was incredible. I mean, we had 4 market-wide circuit breakers, and we operated through that pretty well. And everyone could get prices when they needed them. So yeah. I agree. It's a good use case.
And by the way, too, at that time, we were also figuring out migration to the cloud, right? And we ended up working in a hybrid environment anyway, but there was a lot of forces at work there, and I think that's a great use case of the industry coming together. Right. Yeah, especially from a security perspective as well.
Oh,
I agree with you there.
No, it absolutely is the case.
Yeah, especially when you're introducing all these emerging technologies, such as AI, as an example. I mean, that's going to change the calculus for sure.
It is. I think it already is, and it will probably accelerate.
All right. Appreciate both of your insights. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.